There was a man who ran a Ponzi scheme for 17 years, who stole $65 billion from thousands of investors, who was warned about repeatedly with mathematical proof to the SEC 9 times over 9 years. And nobody stopped him. It's not because they couldn't. Because they didn't want to believe that Bernie Madoff, former NASDAQ chairman, Wall Street legend, pillar of the financial community, could be a fraud. One investor said it perfectly: "You doubt God? You can doubt God, but you don't doubt Bernie." Had that aura about him. Welcome to Finance Untold, where we expose the frauds that fooled everyone. Today's fraud, the man who proved that reputation beats evidence every single time. The man who fooled Wall Street. December 11th, 2008, Bernie Madoff's sons turn him in to the FBI, he confesses. It's all just one big lie. The firm that managed billions for celebrities, charities, and sophisticated investors, a Ponzi scheme. And it had been running since at least the early 1990s, maybe the 1970s. $65 billion vanished, not from a market crash. It's from a lie typed into a computer. But here's what makes this story unbelievable. Madoff didn't hide. He was NASDAQ chairman. He helped design the electronic trading systems Wall Street still uses. He testified before Congress on market regulation. He sat on SEC advisory committees. And for 17 years, he ran the world's largest Ponzi scheme, using 1960s-era dot matrix printers to generate fake trading. Statements while regulators who were supposed to protect investors looked the other way. The whistleblower they ignored in 1999. Harry Markopolos, a Boston options trader, was asked by his boss to replicate Madoff's strategy. His firm was losing clients to Madoff, who consistently delivered 10 to 12% annual returns with almost no volatility. Markopolos later said he knew within 5 minutes that Madoff's numbers didn't add up. Markopolos testified before Congress that Madoff's returns were like a baseball player batting. 966 for the season, compared to .3002. 400 for elite players, and no one suspecting a cheat. In May 2000, Markopolos submitted an 8-page document listing red flags and mathematical proof of major fraud to the SEC's Boston regional office. The SEC ignored it. In March 2001, he submitted a second, more detailed complaint. The SEC ignored it. In 2005, Markopolos submitted a comprehensive analysis titled "The World's Largest Hedge Fund is a Fraud." It laid out approximately 30 red flags. The SEC ignored it again. In total, Markopolos resubmitted evidence to SEC offices in 2000, 2001, 2005, 2007, and 2008. 9 warnings over 9 years. With mathematical proof, detailed analysis, with everything regulators needed to stop Madoff when he was managing as little as $3 billion, why didn't they act? One SEC staffer said the only way Markopolos would qualify as a whistleblower was if he came in with a tape recording of Bernie Madoff admitting he was running a Ponzi scheme. As Markopolos later said, "Obviously I didn't have that tape. If I did, I wouldn't have needed the SEC. The strategy that never existed." Madoff claimed he used a split-strike conversion, strategy buying blue-chip stocks and hedging with options. Sophisticated, conservative, boring. But when investigators looked at trading volume on options exchanges, they found that Madoff couldn't be trading on exchanges because of insufficient volume, and couldn't be trading over the counter because it was inconceivable he could find counterparties for that much trading. In other words, the trades Madoff claimed to be making didn't exist. The volume wasn't there. The math didn't work. Markopolos argued that anyone who knows the math of the markets would know that Madoff's distribution simply doesn't exist in finance, since markets were far too volatile even under the best conditions for this to be possible. But investors didn't ask questions, because Madoff had the perfect defense: exclusivity. If you asked detailed due diligence questions and wanted full transparency and independent third-party custody of assets, Madoff would tell you it's a take-it-or-leave-it black box strategy. "I invented this strategy, and if I let third parties see what I'm doing, they will duplicate it and kill my returns." Smart investors walked away. Greedy investors fell over themselves to hand him money. And Madoff was brilliant in one respect. He let smart investors walk away without being offended. He knew his targets were investors who didn't ask too many questions. As Markopolos put it, "You do and need to be the smartest man in the world to be a Ponzi artist. You only have to be smarter than your victims." The SEC's spectacular failure, here's the part that should make you angry. The SEC had information linking Madoff to a Ponzi scheme as far back as 1992. In that year, the SEC investigated an unregistered investment firm called Avellino and Venus, which was offering 100% safe investments with high, stable returns. The SEC discovered that Madoff managed all their client funds. They shut down Avellino and Venus, but never investigated Madoff. Beginning in 1992, the SEC received information that should have led to the quick end of Bernie Madoff's Ponzi scheme. But because the task was assigned to junior staff or supervisors with insufficient experience, because staff failed to ask obvious questions, and because supervisors actually discouraged further investigation, Bernie Madoff stole $65 billion. The SEC examined Madoff's operations multiple times. In 2005, they checked his brokerage for violations. The staff found no evidence of fraud. Madoff agreed to register his business, and the SEC kept its findings confidential. After his arrest, Madoff told SEC Inspector General David Katz, "They never even looked at my stock records. It would have been easy for them to see if they'd checked with the depository trust company." "If you're looking at a Ponzi scheme, it's the first thing you do," Madoff said. With one phone call, they could have brought the whole thing down. He also admitted, "I worried every time. I wish they caught me 6 years ago, 8 years ago. Think about that." The man running the fraud wanted to be caught. Regulators still failed. The collapse of the scheme began to unravel in fall 2008 during the financial crisis. By November, investors had requested $105 million in redemptions, though Madoff's Chase account had only $13 million. He couldn't pay. The Ponzi scheme requires constant new money. When redemptions exceed deposits, it collapses. On December 10, 2008, Madoff confessed to his sons, "It's all just one big lie." They contacted the FBI. The next day, Madoff was arrested. On March 12, 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, making false filings with the SEC. On June 29, 2009, he was sentenced to 150 years in prison, the maximum allowed with restitution of $170 billion.
Ow!
He died in prison in 2021. The damage? The official estimate, $65 billion in losses, the largest Ponzi scheme in history. But Harry Markopolos estimated that at least $35 billion of the money Madoff claimed to have stolen never really existed. It was simply fictional profits he reported to clients. Real cash losses? Around $18 billion. But thousands of lives destroyed, charities wiped out, retirees lost everything. And some victims couldn't handle it. Magon de La Villehuchet, a French hedge fund manager who Markopolos personally warned about Madoff, refused to disengage. After the collapse, he committed suicide, having lost $1.5 billion of his own and clients' money. The real lesson. So what's the lesson? It's not just that Ponzi schemes are bad. It's deeper than that. The lesson is this: reputation is a shield. And when reputation is strong enough, people will ignore math, ignore evidence, ignore warnings, because believing the lie is easier than accepting that someone they trust is a fraud. One sophisticated hedge fund investor told investigators he knew for sure Madoff was running a Ponzi scheme because he had seen Harry Markopolos' complaint and knew that the SEC would look at it carefully. There's no way they wouldn't have caught the Ponzi scheme, he thought. The SEC's failure to act became proof that Madoff was legitimate. Madoff constantly referred to SEC examinations as a way to convince hesitant investors. "The SEC just examined us," he'd say. "Everything's fine. It was the perfect con. It had worked for 17 years. Here's the uncomfortable truth. Markopolos stated he feared for his and his family's safety if Madoff discovered his activities. Markopolos claimed Madoff was taking money from organized crime, and that Madoff would have had him killed rather than let organized crime groups discover their money was going into a Ponzi scheme. Whether that's true or not, it shows you the power Madoff wielded. This wasn't just a con artist. This was one of the most powerful men on Wall Street. And when you have that much power, people don't investigate you. They protect you. The SEC failed because they couldn't imagine Bernie Madoff, NASDAQ chairman, market legend, regulatory advisor, was a criminal. And so they didn't look. And when evidence was handed to them, they dismissed it. Madoff proved that the biggest scams don't hide in the shadows. They hide in plain sight, protected by reputation, trust, the unwillingness of people to believe that someone successful could be corrupt. And that's the scariest part, because frauds like Madoff still exist. They're respected, they're trusted, they're sitting on boards and advisory committees. And when whistleblowers warn regulators, those warnings are ignored because reputation beats evidence. Hit like if this opened your eyes. Subscribe to Finance Untold. We expose the frauds, schemes, and scandals that Wall Street tried to bury. Turn on notifications because financial fraud didn't end with Madoff. It just got more sophisticated. Drop a comment. Which scandal should we cover next, Enron? Long-term capital management? Click the link for our free guide. How to spot a Ponzi scheme before you lose everything. Learn the red flags Markopolos used to uncover Madoff in 5 minutes. Bernie Madoff stole $65 billion. Odd. But the real theft was trust. And Wall Street still hasn't earned it back. Thanks for watching. Stay financially untold.